Let's bring in Paulsen Perspectives author Jim Paulsen. Jim, good to see you. So does the market think an attempted Powell firing isn't going to happen, or it just doesn't matter if it does?
I don't think anyone really believes that's going to happen, John. I think that what happened today with Trump, to me, fits Trump's MO and how he negotiates and how he deals with adversaries, or what he perceives as adversaries. He delivers threats. His idea of negotiation is to drop a concussion bomb inside the room and then go in to negotiate. And he feels like if he keeps pressure on the adversary, he'll eventually get him to where he wants them. And he does that with political foes. He does it when he's negotiating peace. He does it with his tariff war. Why not do it with the Fed? I don't think he has any intention to fire him, particularly this close to when he's going to have to leave the chair anyway. But I think by raising this issue, that we're all talking about it, we're all asking the question, is the Fed too tight for too long? Should they ease interest rates? And it keeps the pressure on the Federal Reserve as a whole. And I think that's what he wants to do.
Okay, but it's easy to get distracted by the details. They are exciting, they are interesting. But from an investor perspective, is the bottom line that rates are more likely to come down now one way or another?
I don't, maybe a little bit at the margin, but I don't think so. I think today's actions had little impact. I think more importantly, you got to look at the economy's performance. And really, I think growth in the economy is pretty slow here. We had a 0.5% decline in real GDP in the first quarter. The GDP now is corrected a little over 2% in the second. We'll be growing at around 1% for the first half of this year in real terms. That's very weak. Job numbers, I think, have been on the weak side here for a period of time. I think inflation is staying under control. And so I think the Fed is going to ease. And I think the market, by the way, is acting more about that than anything else. Already, the dollar has been coming down. The money supply has been increasing more. Fiscal juice is still pretty strong. We're already starting to see markets starting to react to that, doing a little better overall, even some of the broader parts of the market, I think because of the anticipation that the Fed's going to have to ease pretty soon.
So in light of that, what do you buy here? Because we know we have an S&P that's at lofty valuations, arguably. But we also know breadth has been very narrow. So where do you see opportunity?
I would look to the broader market, to finally giving Morgan a broad market advance, which we just simply have not had in this bull market. I think a lot of that is because of the tight Fed throughout this bull. They've withheld a lot of the normal stimulating factors. By keeping the funds rate either going up or high, they've kept bond yields high, they've kept the mortgage rate high, they've kept the dollar strong, they've kept money growth weak. And I think if they are going to ease, all of that is going to turn positive for the stock market. And that's what you generally get at the start of a bull when everything goes up in broad market plays like small cap stocks, international stocks, value plays, more cyclical plays do better than growth and even technology. And I don't think tech is going to fall apart, or the growth part of the market, but I do think you want to move to an underweight in those areas and to think about some of these areas that have not yet participated that I think will if the Fed finally comes in with a full-on ease.